Welcome to the Reverse Mortgage Podcast. I'm Bill Gross, at Bill Gross Probate on social media. And I have again today as our guest, John Thompson, who is a liability advisor. We're going to find out what that means, with a company, SMPL Mortgage. But the tagline and the website, the place to get information from him is Borrow Smart. Well, I need to get this right, so let me make sure you're right. BorrowSmartReverse.com. John, thanks for coming back to our program.
No, you're welcome. Thank you, Bill. It's a pleasure to be here again. Looking forward to it.
So I've been around quite a while, and I'd never heard of the title liability advisor. What's a liability advisor?
You know, at the end of the day, people, tend to think about managing their life around the money they have and so forth, right? So there's lots of ideas and thoughts around how you manage money, how you grow money, how you create financial wealth and so forth. But very little time is spent on thinking about the liabilities. And the reality is, I believe that for most people, if they spend a little bit more time focusing on the liability side of their personal balance sheet and getting their cash flow better and so forth, they'll actually add to their wealth over time anyway. So we focus on the liability side. We let the financial professionals that work on the asset side do their work. And then we're on the liability side. So that's what we do.
Now, when you say liability, I think what you're saying is to strategically manage the liability so that it can be an asset. Right? You're not talking about, we're not talking about insurance necessarily or avoiding being sued, but the mortgage lien is a liability, and one can have a regular mortgage, a reverse mortgage, cannot have a mortgage, can have a line of credit. All those are strategies using the mortgage liability side of the ledger, but using it strategically, almost like an asset. Is that a fair assessment?
Yeah, that's great. Thank you. I think you've said it far better than I could. So thank you, Bill. But, at the end of the day, you're right. Yeah, I mean, most people think of liabilities. They're worried about risk and being sued and that sort of thing. But we're really talking about the context, mostly of mortgages, right? So we're in the mortgage business. We only get paid to do mortgages. But at the end of the day, that's just one element of liabilities. People have other sorts of debts. They have student loans and car loans and credit cards and all these other kind of things. They're all wound together at the end of the day. And again, I feel that the better decisions you make around all these liabilities or debts, payments you have, the better job you'll do in managing your other assets. And because we're both connected through real estate, real estate is both an asset and in many ways a liability, right? And people don't always understand the interplay between those two things at the same time.
I think also people tend to think of a loan, whether it be a mortgage or car loan or student loan or credit card, as a siloed decision. And just like on the asset side, you should think about your stocks, your bonds, your real estate, your collectibles, your gold, whatever you have.
Mm-hmm.
And it should be properly distributed and properly hedged and properly different types of assets that are appropriate for you and who you are. I think you're talking about on the liability side doing the same thing, that perhaps rather than just buy a house and have a mortgage and pay it off in 30 years and forget about it, you're really saying, let's take a look at that whole side as a strategic activity and how can we maximize your results or minimize your costs?
Absolutely. And you said it perfectly. When you said silo, people really do make many, many financial decisions in a silo, meaning they're in a vacuum, right? They're not thinking about how the decision today on how much of a mortgage, what the payment is, all these elements of that, how that affects every other element of their financial life, right? And so they make the decision, they move on, and then there's unintended consequences in many things that happen in the world, but especially around personal finance, there's unintended consequences. So that's where we're coming from it. So it's a lot of fun. It's really fascinating. It is a unique approach, I think, to the world that we work in the mortgage side. So.
Yeah, I think it's more complicated and more personal interaction with the customer than a regular mortgage where you're just trying to get the rate, lock it in, maybe execute, get the loan done. This is really about being part of the planning process. So let's talk about first, what are the options of reverse mortgages? Like what's the range of choices one has? And then we can talk about some of the specific strategies on how to use those proper options for an individual customer.
Sure, no, thank you. At the end of the day, the majority of the marketplace around reverse mortgages is in a product really the formal name is what's called the home equity conversion mortgage, right? Kind of a fancy name. What's it mean? Well, home equity conversion, converting home equity, mortgage, right? So you're using a mortgage to convert home equity into something else, which is either a cash flow or a payment or a line of credit and some things like that. So that's about, last numbers I saw, maybe 95% of the marketplace. And that home equity conversion mortgage is supported by the Office of Housing and Urban Development, HUD, the FHA program. So it's an FHA, Federal Housing Administration program. They don't make the mortgages and they don't make the loans, but they set the guidelines that we all follow in the industry across the United States. The other sort of 5% of the marketplace is known by a couple of different names. They're proprietary, jumbo, private, and so forth. It's just they're loans that are made by private companies that don't necessarily follow the same rules as the HECM rules, right? There's more flexibility in terms of the type of property, the loan amounts, and some things like that. So different strategies come into play with those as well. So those are the two major pockets. There may be some private stuff that I don't know about, but those are the things that we'll be talking about and that most consumers are aware of.
So within the realm, though, there's just a mortgage, meaning you have a house, you have equity, you're buying it, and you agree to pay a certain amount of money back over time out of the equity. You're not making mortgage payments, but you agree to give up a certain amount of equity over time. And then there's a loan where you don't take any of the money, but have the right to later advance it, an equity line of credit that's associated with a reverse mortgage. And then there's maybe some in-betweens where you can maybe get money on monthly payments. And so talk a little bit about, given those three options, getting all the lump sum, getting a line of credit, and getting monthly payments, how might one strategize those three particular choices?
Yeah, I think that's well said. And I just want to go back to the point that you said, so when you have a reverse mortgage as opposed to a forward mortgage or a regular mortgage, let's call it that. On a regular mortgage, you're making payments over time. It slowly goes down, right? On a reverse mortgage, if you opt not to make payments, and by the way, many people don't realize that you can make payments on a reverse mortgage, and there's many strategic reasons to make a payment on a reverse mortgage, maybe we'll talk about. But if you don't make payments, the balance will go up over time, right? Because you're essentially borrowing from your equity. Instead of making a payment, you're borrowing from the equity. So Bill, as you pointed out, there's really three ways to sort of access the amount of money you're eligible for. And as you point out, there's a lump sum, meaning that you can take, let's just say you're eligible for $400,000, just for argument's sake. You can maybe take a lump sum of $200,000, and that's just cash that you have. It goes in your bank. You could then maybe take payments of $500 or $600 a month, and that's called a tenure, like a professor's tenured, like over your lifetime, a 10-year payment, or there's the line of credit. And so again, sticking with our $400,000 example, maybe you take $200 in cash, maybe you take some payments that uses up another $100,000, then maybe there's $100,000 left over in a line of credit. The line of credit is really unique. It's actually what I consider, as an advising professional, the most unique part and the best part of the reverse mortgage, that the line of credit grows. So the portion you don't use is growing over time. It's getting bigger and bigger and bigger, and this provides a lot of strategic benefits in terms of protection and so forth. I think people are used to the idea that if I have $100,000 in a savings account or an investment account, that money's going up over time. I can use it later on for stuff. Just like the line of credit in reverse, it's going up, it's growing, growing, growing. You don't make payments on it, there's no interest on it, but if and when you need it, it's there for other purposes. And so and you mix and match all those different things depending on your strategy and what you're trying to accomplish.
And so I think that obviously a reverse mortgage, the classic where you buy a house, don't make payments, that's a choice for some people, and there's some circumstances, and I think that's fairly straightforward. I think where you might take money out monthly, maybe you're offsetting some major other expenses, property taxes, insurance, medical insurance, long-term care insurance programs, things like that. I can see you set that up. The line of credit, I think, is the one that's most underutilized for my customers that should have it, because it seems to me that if you have the ability to protect your equity with a line of credit in case of emergency, you should have that set up when you don't need it. So when you need the money, it's available. Now, it's like everything else in life, trying to get customers to do things they don't need at the time, they may need in the future, is challenging. But I think like me, you've probably had customers who set up that line of credit and something happened they didn't foresee, and all of a sudden they can withdraw $200,000, $300,000, $500,000 and either use that to buy something or to pay for to put into an investment property of some sort. Talk a little bit about the importance of planning when you don't need the equity to have access to it in case you might need it.
Yeah, you're spot on when you say it's the sort of it's not necessarily the least utilized portion of it, but it's the least understood about how it can be used strategically, right? So I personally think that if you have a lot of home equity, whether you're eligible for a reverse or not, you should always have some sort of line of credit to have access to your equity, right? Because it's not liquid. They could call you, Bill, and sell the home, but it might take 30, 60, 90 days to get their money, right? With a home equity line of credit, which is different than a reverse, but you have access to that money over time. It's just a protection strategy. So the reverse is kind of the same thing. I think people are making a huge mistake when they either pay off their mortgage or buy a home for cash and so forth. They don't, at the very, very least, set up a line of credit or the HECM line of credit if it's available to them, because it's going to grow. And yeah, there's costs and expenses for everything up front. We would go through life, we pay tens of thousands and sometimes hundreds of thousands of dollars in insurance for car accidents we never had. I know home insurance is a difficult thing to think about right now with what's happened in LA in the last month or so, but we pay for home insurance oftentimes with no tangible benefit that we see in life insurance. All these things we have for, at the end of the day, the cost and expense of a reverse mortgage, while not insignificant, pales in comparison to if you need that money later on and you can't get to it, right? That's the key thing. And it can grow. You can start at zero, and literally it could be 10 years later, it could be $500,000 or more to have access to. And people use it most. I can tell you the most common strategy that we see is actually preparing to pay for in-home care, right? So long-term care, if they don't have insurance, because it's gotten very expensive and it's not easily accessible, you'd pay for in-home care through the reverse mortgage. That's the most common reason that we see people setting it up with their financial planners and talking about that aspect of it.
Or moving into a care facility, right?
So that's tricky because the equity's there, but you have to, with a reverse mortgage, you have to live in the home. So if you need to move into a care facility and you're doing it for less than a year, let's say you broke a leg, you had a hip, something happened, and one or other of the spouses had to go into a facility, that is fine. You can do that for up to 12 months. After that point, you're technically supposed to be back in the house, right? So it's not the kind of thing where you move the money and you move into a facility and you're gone for the rest of your life. It's a short-term solution.
Right, but you can take the money and buy the care facility, the new home or whatever, and then sell the residence. But now you have the luxury of moving out before you sold the property versus trying to sell while mom is in there and she's infirmed or whatever's going on. I think that oftentimes people are forced to make a decision because the equity's in the house versus, well, if we had $500,000, could we just move mom now and then conveniently get the house ready for sale and then sell it? And we'll pay off the mortgage lender. We're not trying to scam them. We want to pay it all back, but we just want to do it in an orderly manner. And so that's the case that I've seen. And I've also seen people not take advantage of, because if you have the line of credit, people say, well, we have enough money to get through a few months. Well, that sounds great until the house burns down.
Right?
That's all great until something happens. And then all of a sudden, now what do you do? And I literally have customers who, that obviously in the policies, that's the case where they moved out and they thought, well, we have a few months, we have $43,000 cash and we can cover mom for a while, but now they can't sell the house. Who knows whatever, if I'll
you're going back to advanced planning that you mentioned before, right? It's the same kind of thing. A very, very common situation. We get the phone call again from the adult children. Mom or dad is, they've burned through several $100,000 in cash in the last couple of years. We're down to the point where they've realized they're going to have to pay for it, or something else is going to happen. They got to sell the house. Something's going to happen. And they wait till they're down to 2 or 3 months, right? And now suddenly mom has to go to facility or dad or whatever. And now they're not in the home and they can't qualify for the reverse mortgage because they're no longer in the home. So you got to do this stuff in advance and be thinking. It's just a simple protection strategy. Learn about it, see if it might work, and then make a decision from there.
And I think commonly people like you and me, I live in West LA. I think you're in Pasadena or in Southern California, and people move out of California to retire in Arizona or Florida, and maybe they sell their $2 million Pasadena house and they buy a much smaller, nice new $500,000 senior living facility home in Pasadena, in Arizona. They can take their reverse mortgage and just buy it for cash. And let the kids, again, now the mortgage is due and they have to deal with that. But, the process is so different than when they're not planning ahead. And I think that's the case.
That's right. And you buy time, right? So if you have access that you have sitting there and you need to move, they're buying time and buying the opportunity to do something else, right? And that's really what it is.
When people use the reverse mortgage as purchase money, so if I'm moving to
Yeah,
Florida and I have cash, I can buy the place for 500,000 cash, but I want to have that line of credit in place when I buy it. I always feel like it's always best to do that as the purchase because you have the title insurance in place, and you have whatever other documents are done properly, rather than buy for cash and refinance. I think it's better
yeah.
just to do it with a loan, but it's not so often done. What's the time period for somebody who wants to get a line of credit to purchase a property,
Yeah.
maybe in a retirement community in another state?
So the program, technical name, just so if people hear it somewhere else, if they're reading or doing research, is called reverse for purchase, R for P, right? And so, yeah, a lot of people don't know you can use a reverse mortgage to purchase a property. And yeah, I agree with you 100%, Bill. You should do it at the time. Even if you could pay cash, go ahead and get maybe a $200,000 reverse mortgage. Number one, you get to keep part of your cash anyway. And then number two, you set it up, because what we find happens, people will pay the $500,000 for the property. Oh, I'll get the reverse in 2 months, 6 months, 12 months. And guess what happens? They never do it until, again, it's too late, right? So they have the advantage of the transaction in place. Like you said, they have title insurance and they have people who are willing to help them at the time.
Right.
This is important, right? You got your advocates, you got your team behind you. They'll get it done. Time frame is what you asked for. Quite frankly, it's not much longer than a normal escrow time period. If we assume a normal escrow period is 30 to 45 days, it runs about the same. There's nothing really unique about the reverse mortgage process other than upfront where you have to do counseling. And so if people are thinking about the option to do it, they need to do counseling. Typically, that might take a week or 10 days on the front end. You don't want to end up in escrow and then still have to do counseling because that will cost you time. But if you're planning a little bit in advance and you think the reverse might be good, you do the counseling, get out of the way. It's good for 6 months, right? And then you got all that time to do everything. And then it's a normal time frame. You can get a reverse mortgage for purchase done in 30 days. And we did one very recently, and it went great.
And I think the other thing that you mentioned in passing, and you can't brag about yourself, but I will, which is that if you do it at time of purchase, and you ask your realtor, hey, who's a great reverse mortgage specialist, you're going to get a great mortgage rep who specializes in the product. I would refer you to John to do it.
Yeah.
Whereas if you wait till later and you're in the house and you watch some TV ad and you call an 800 number, you're going to get the kind of person who works for a company that gives you leads on an 800 TV ad. And I can tell you as a professional, it's not good. 80% of all salespeople are terrible. It's the top 10 or 20% that really get things done. And so the opportunity when you buy the property is talk to your real estate professional and say, well, who's really, really good and who can handle it? In some cases, let me ask you, John, are you licensed in multiple states? Are you licensed to do loans?
We are. Our firm, the firm that's backing us, is licensed in 39 states now. Right. I'm personally licensed in 4 states, and the rest of our team's licensed in about another 4 or 5 states, mostly in the Western U.S., Arizona, Colorado, Washington, Oregon, so forth, Idaho.
But you can do them. You can assist us in Texas and Florida and other key places.
Yeah. So and so when I say the company's licensed in 39 states, that means that we have loan officers within our firm, right, that we can send to them. I trust them. They're people we know, and we would help with that part of the transaction.
And that's an important distinction. I think one thing about real estate I've learned, and that's why I do these podcasts, is the key to business is working with the best people, because it's like there's 2 worlds. There's the world of you walk into Bank of America and ask for a reverse mortgage.
Yeah, that's right.
Anything there. It's just a nightmare. And yeah, I'm sure even within companies like the big banks, the top 5 or 10% are really good, but you can't find them walking in the branch. You find them through real estate professionals and other, attorneys and accountants who work with people and see the results. And I think that's the key to this.
Yeah, it's well said. And I'll point out that within the reverse mortgage space, there is and maybe you're going to bring this up, but there's a designation called CRMP, a Certified Reverse Mortgage Specialist, CRMP professional, CRMP. And it's a designation that's put out by a nonprofit called the Reverse Mortgage, National Reverse Mortgage Lenders Association. So a very well-connected industry nonprofit, works with lenders and with our government to help put policy together and so forth. Anyway, that designation is very difficult to get. The only test I failed as an adult There's less than 200 of us across the country that have that designation. Very, very difficult. You have to go through ethics and training. You have to have 3 years of experience. You have to have closed 50 reverse mortgages or more. I mean, you have to get a recommendation from a professional within the industry. So a difficult designation to achieve, but look for professionals that have taken the time and effort to learn more. Some certifications and so forth. That's just one. There are other certifications, but that's the one that I believe is the highest level in our business today.
Yeah, thank you for bringing that up because we spoke previously, you mentioned it, and after we spoke, I researched it. I agree. I think it is the preeminent. Not only that, they have all the members' information on a website directory. Not only that, I have my virtual assistant take those and invite just those members. So the only people on this podcast are going to be certified members through that organization. And I just felt like, because I know as a realtor, every single lender I ever asked, do you do reverse mortgages, says yes. They may have never done one. They may not be able to spell the word reverse.
Yeah.
But every lender will say, yeah, or I know, oh, is a guy my team? Oh, yeah, I could. No, you can't. Just say no. It's okay. Just say no. There was a famous, Nancy Reagan? Just say no to drugs. Just say no. You can't do reverse. Let the pros handle it.
Just say no to the drug that is reversed. But it's tough. I'll just share a very quick story. How I got into the reverse space. I was asked for years to do them, and I wouldn't do them because I view myself as a professional. I'm not going to talk about anything, sell anything, teach anything, educate anything if I don't completely understand it and feel confident to be able to share it with my clients. So I kept having financial advisors say, you got to do this. Our clients say that we trust you. We know you'll figure it out.
Yes.
Eventually I broke down and learned about it and got all those certifications and so forth. My very first deal was for an insurance professional to help his mom because he said, I trust you and you'll figure it out. And so at some point, this was about 12 years ago. And so now it's a key part of our business. I love doing it. I love talking about it and teaching and educating. Not for everyone, but where it fits, it's a fantastic product, as you know, Bill. So.
As a realtor, I mean, I'm licensed, and I also have a NMLS license. I don't do loans because that's just out of my area of expertise. I wasn't a loan originator for the first time in my career. I've done reverse mortgages. That's why I appreciate the value of the product, and I see the distinction in the difference between people don't. I also, as a real estate agent in probate, see how both they're underutilized and how there's a challenge with reverse mortgages. I don't think this is really your area because it's more servicing, which is that because there's a mortgage payment made when the person who owns the property and it's really the second or surviving spouse passes, oftentimes, there's no mortgage being made and people think, oh, wow, this is great. And we have this reverse mortgage. Well, the death certificate has a social security number, which gets reported to Social Security, which gets reported to the mortgage lender servicer, who will then notify the people and say, hey, we see that you passed and you have, I think it's 6 months, and then there's a different process to review it. I get involved there oftentimes late in the game. And so we actually have a program to help those customers where we actually can refinance the reverse mortgage if you file the probate with us. And that's becoming a more important part of our business. And so I see this and saying, wow, and I don't expect, John, for you to talk about the customer, what happens when mom and dad die with reverse mortgage, because you hope that's 10 years down the road.
Sure.
But it's a real part of the business. And I think that mortgage servicers don't want to deal with it. They just sell the servicing rights to a foreclosing company. And it becomes a very ugly part of the process.
They do, but it's an important part. So to the degree that someone hears this at some point and learns about it, but so if you have a family member, friend, and they've passed with a reverse mortgage, there are steps you have to take. And technically, the minute that the servicer finds out that the person has passed away, they file an NOD, notice of default, right? So that means you're in default to your mortgage, which normally means a foreclosure is coming. Now, they do that because technically you are in default. If the person is no longer alive, you have to be alive to have a mortgage. And so you're technically in default, which is the same with any mortgage, but people freak out because it's a reverse. Right. So you need to notify the lender. They'll give you sort of 90 days to tell you what you're going to do, sell it, refinance it. If you're going to sell it and there's financing available through the program you just mentioned, great, go do that, get it done. But technically you have 6 months to then make a decision. If you have nothing done at that point, you can usually get 2 90-day extensions and so forth. But the key to anything, not revert, is communication, right? So as you point out, Bill, we hear from realtors all the time who've gotten involved. They're 2 or 3 months down the road, and now they're like, what do we do? What do we do? right? And just, you got to call, got to be proactive and communicate. The same for anybody. So,
Yeah, I get phone calls where the trustee sale is scheduled like 10 days out.
and they haven't done it yet.
Well, they like we called the lender said this, the lender said that. Well, did they give you in writing? No.
Yeah.
So, this is not an area,
Yep.
if you talk about significant equity, this is not an area to deal with on your own. This is where you get professional help. And I think, again, the people who deal with stuff regularly are the ones you want to turn to. Filing a probate can take months. And so to think you're going to get the probate open to deal with it may or may not be the right answer. Certainly, if you're going to do it, it has to be done properly. And that's, like I said, that's why we've launched this podcast, is to work with the best reverse mortgage lenders to get them in business, and then also to help their customers. When you get that phone call, what do I do, to be able to answer those questions as well. So let's talk a little bit about, kind of change hat a little bit and talk to,
Yeah.
I know you have a team of your own, so we'll talk to them and your colleagues about what you see as the business opportunity going forward versus mortgage. You see it growing, expanding? Do you see it as just one of several pieces? And what, if anything, are you doing in this particular niche to help you build that business?
Yeah, no, thank you. So as you pointed out earlier, it is the reverse mortgage, the HECM, is a severely underutilized, tool, right? I can't remember the stats I saw recently, but I think it says something like less than 1% of the age eligible, meaning they're over the age of 62, who got a mortgage actually and would have qualified for reverse mortgage, took the reverse mortgage. So a really, really small percentage.
Yeah.
And so if they were not taking the reverse mortgage, what did they do? They took on mortgages with payments. They did all that kind of stuff, or they didn't qualify, right? They didn't even know it was an option. So they didn't qualify for a mortgage, in which case they sold their home, or they're renting or living with family. So all sorts of other things. There's a huge marketplace, for the product and at the end of the day. But, so it's underutilized. We know that's fair. Where are the opportunities? There's, I think there's really sort of three levels, unfortunately, people that tend to, move towards the reverse mortgage. Everyone knows that there's the sort of needs-based borrower. So a needs-based borrower is someone that has a home, they have a lot of equity, they don't have a lot of income or other assets, right? And so they're just kind of struggling, they're paycheck to paycheck, inflation's killing them, all this kind of stuff, right? Those are needs-based clients, and they're out there, and eventually they see a commercial on TV at night or whatever they do, or an ad, and they reach out and they get with someone. You then have, sort of the very high net worth people. So high net worth people are not a huge marketplace, because there's not a ton of people with tons of money. Although in California, real estate, $3, $4, $5, $8 million pieces of real estate, and you got money in retirement accounts and so forth. Those people are starting to look with their financial planners about, how do we use that product to get access to cash, maybe for advanced inheritance planning, for legacy planning, for their kids, making donations to other charitable organizations without incurring a payment, those sorts of things. So there's tax plays that come in. We won't go into all that today. But then in the middle is mass affluent. And mass affluent are folks that have a home, maybe it's worth $1.5 million to $2.5 or $3 million. They still have a mortgage, and they're entering their pre-retirement or retirement years. They're 55 to 60 in that time. They still have a mortgage, and they have money, right? They're making good money, and they've got, maybe $800,000, $900,000, maybe $1 million in a retirement account. They feel wealthy, but they're in California, right? And so I'd say if they're not wealthy, right? And they're going to run into trouble because they're going to have a mortgage. They're going to have to start slowing down at work and so forth. That's where there's opportunities for people to do different planning. Downsizing and taking part of the equity and getting a reverse for purchase, like we kind of talked about. Maybe doing what we call the IRA stretch, where you're running out of your IRA money, or you're taking too much every month, and you're incurring taxes because you're taking too much. You're taking above your required minimum distribution, right? And so a better plan might be to put the reverse in place to eliminate the underlying mortgage payment, so you can slow down your cash flow, stretch out the IRA. And maybe you're actually increasing your wealth over time to pass on to your kids, right? It's all numbers, and it's all sort of thinking and strategy. So I think there's huge opportunity, and it's all over the place. It's everywhere. Not to mention the sort of the long-term care issues out there, and paying for insurance and home health care and so forth. The sandwich generation is real. People, I just turned 60, so I'm probably at the older end of that. But people that are in their mid 40s, the mid 50s, and they're still paying for kids in college, and they got aging parents, there's a lot of money that's going to go around. And the reverse can solve a lot of those problems.
I think that, just again, being in this business daily and listening to you describe it, the thing that strikes me is that the opportunity is in the edges, which are a little more complicated and complex.
Yeah.
And that's why, for example, on this podcast, because I think the solution is education. The more people, the statistics you mentioned were staggering. I think you're right. I would say of that people about the properties, 75% don't even know there is such a thing.
Yeah.
That's even a reasonable option as a reverse mortgage. That would triple the number of case use. I would just right off the bat. And so I think there's a tremendous opportunity just with education.
Yeah. No, you're right. And another stat that's a little startling is that, going back a couple of decades, a relatively small, maybe it's 25 or 30% of the people entered retirement with mortgage or with debt. That number is up to 65% entering retirement with debt, not maybe just mortgage debt, but other types of debts and so forth, right? So this is why the liability management is so important, right? Just everything has gotten so expensive across the board. And so the fact that 2/3 of our country are entering retirement with, in some cases, very significant debt, just shows what the opportunity is. The great thing is there's home equity, right? We have great real estate here in Southern California. We've been very fortunate to have, the growth of real estate over the last several decades. And, because you talk about it all the time, what's the law of supply and demand? And the reality is that with the law of supply and demand, prices are going to continue up. Maybe it's not a straight line. It's going to change. But the reality is they're not making any more of it. Right? And so the values are going to continue to go up, which is an opportunity.
Yeah, I also noticed, when we did some research, because this overlaps with my other podcast on probate, that there was not a lot of education online in the reverse mortgage field. Now, part of it is because maybe I believe the originators of reverse mortgages tend to be older than the average, and as a result, they're less on social media.
Yeah.
But at the same time, your customers, my customers, are getting less education opportunities, and so that's why I just want to say on behalf of people watching, thank you for taking the time to do this and explain it. I think a lot of competition feels like they want to keep it a secret to get their own business, which, I don't know which is right or wrong. I personally feel like the more people educate in the long run, my business flourishes. Whether people copy my advice for free or come to me for that advice, it all works out. And I think you come from the same place. I know.
No, I can tell, Bill, that about you. It's true. A rising tide, as the saying goes, lifts all ships.
Yeah.
And it's true. I mean, I'm happy to talk to anyone, anytime about reverse, good, bad, ugly, whatever people think, and I think you're right. I mean, it is feel weird that a lot of people in my business don't want to talk about it. They do want to kind of keep it a secret. I'm not sure why. It makes no sense to me.
It's so interesting that,
our jobs are to act as fiduciaries, right? Which means we're putting our clients' needs ahead of ourselves. And that's what we need to do every day. And if a reverse fits somewhere and it helps them create their lifestyle they want, or their kids or the family, whatever, then let's talk about it. It's very simple.
And let's keep it in the hands of the professionals like you, John. So, John, thank you so much for your time again today. For those who are interested, the website that you would go to for more information, both in general about reverse mortgages and about John's company, is borrowsmartreverse.com is the website. borrowsmartreverse.com. We'll have the link down below in the description. And he's with SMPL Mortgage, and they have a phone number on top there, 626-583-1623. You can get a click there to get a quote. And John, just on behalf of people watching, thank you again for your time. I really appreciate it.
Thank you, Bill. And thank you for putting out the education and getting it out there. I think it's wonderful. And, whatever I can do to help you continue to spread the word here. So thank you.
Thanks so much. And for those of you watching, again, this is the Reverse Mortgage Podcast. You can continue the conversation. We have a Facebook group. The Reverse Mortgage Podcast is the Facebook group. You can go in there. You can ask questions for further information. You can reach out to prior guests, or looking for referrals in other states. If you're looking for attorneys or some legal help that's beyond our means, it's a great place to do that as well. So for the rest of you, please, if you like to subscribe, like the button. If you have comments or questions, put them there. I'll route them back to John or whoever's appropriate. I'm at Bill Gross Probate. Thank you so much for your support.